It's a Tuesday afternoon in Melbourne, 1978. David is 26, an electrician. 4 years into steady work, enough saved for a deposit, not a windfall, just enough. He walks into a bank, sits across from a man in a gray suit. 20 minutes later, he's approved for a mortgage. 90 days after that, David owns a home. 3 bedrooms, brick, small yard. 15 kilometers from the city. The purchase price is 3 times his annual income. He doesn't feel fortunate. He feels ordinary. His brother did the same thing at 24. His father did it at 23. His co-workers are doing it right now. Homeownership wasn't a milestone in 1978. It was a Tuesday. Now meet Emily. She's David's granddaughter. Also 26, university educated, full-time employed as a project coordinator. Earns more than David ever did, corrected for inflation. 5 years of work, solid savings, clean credit history. She cannot buy a home. Not a large one, not a modest one, not anything within an hour's commute of where she works. The median home in her city now costs 13 times the median annual income. The deposit alone, assuming she saves aggressively and prices freeze tomorrow, would take nearly a decade to accumulate. Prices will not freeze tomorrow. Emily hasn't failed. She's done precisely what she was told to do. Work hard, save money, build your credit, and she is structurally locked out. This is not a Melbourne story. It's the same story in Sydney, Auckland, Toronto, Vancouver, London, Amsterdam, Dublin, San Francisco, Stockholm, Seoul. The pattern is global, synchronized, and accelerating. And almost no one in a position of power will tell you why, because it didn't happen by accident. The standard explanation goes like this. There aren't enough houses. Demand is high. Supply is constrained. Zoning is restrictive. Builders can't keep up. Immigration is adding pressure. Therefore, prices rise. This narrative is everywhere. Newspapers, government reports, ministerial speeches. It is technically accurate, and it explains almost nothing. Here's the question that narrative cannot answer. If this is a local supply problem, why is it happening everywhere simultaneously? Housing markets are local by definition. Tokyo's zoning laws have nothing to do with Toronto's. Ireland's construction industry is structurally different from Australia's. Germany had decades of low immigration. Houston has some of the loosest zoning in the developed world. Japan builds more housing per capita than nearly any comparable city on Earth. And yet, the unaffordability curve bends the same direction in all of them, at roughly the same time, at roughly the same rate. You cannot explain a globally synchronized phenomenon with local, idiosyncratic causes. Something else is operating, something structural, something that crossed every border and regulatory system at once. The answer is not how many houses are being built. The answer is what a house became. For most of the 20th century, a house was a consumption good. You bought it to live in it. Its value was its utility, shelter, stability, a place to raise children. Prices were loosely tied to local wages. Mortgages were tightly regulated. Credit was conservative. Banks didn't want to lend money that couldn't be repaid. Housing was not where people got rich. It was where people lived. This wasn't ideology. It was structure. The financial system wasn't designed to treat residential property as an appreciating asset. Governments in the post-war period, across the political spectrum, treated affordable housing as part of the social contract. In America, the GI Bill helped veterans buy homes. In Britain, council housing provided millions of units. In Australia, home ownership was the expected reward for honest labor. In Germany, rent protections kept living costs stable. Then, the architecture changed. In the United States, the Depository Institutions, Deregulation, and Monetary Control Act of 1980 lifted interest rate ceilings. The Garn-St. Germain Act of 1982 deregulated savings and loan institutions. Lending standards began to soften. Mortgage credit became more competitive and more available. In the United Kingdom, Thatcher's right-to-buy policy in 1980 allowed council tenants to purchase their homes at steep discounts. Over 2 decades, more than 2 million units were sold out of public stock. Almost none were replaced. The government privatized its affordable housing supply and called it expanding ownership. In Australia, negative gearing, allowing property investors to deduct rental losses against taxable income, became entrenched policy. In 1999, a 50% capital gains tax discount was introduced. The tax code began actively rewarding property speculation over productive investment. None of this was sold, honestly. None of it was framed as a policy to inflate asset prices. It was framed as democratizing wealth, giving ordinary people a stake in the system, expanding opportunity. But there was a second-order effect that no one said out loud. When you make it easier to borrow money to buy a house, you do not make houses cheaper. You make them more expensive. Every additional unit of credit entering the housing market gets absorbed into the price. This is not speculation. It is how asset markets function. When demand rises and supply cannot respond immediately, prices rise to clear the market, and housing supply cannot respond immediately. Land is finite. Construction takes time. Planning approvals take months or years. There's no mechanism to double housing output on demand. So credit expanded, prices rose, and everyone who already owned a home got wealthier. Not because they worked harder, not because they contributed anything additional, but because they were standing in the right place when the money arrived. That was the moment the game changed. Once prices began rising faster than incomes, a new logic took hold. If your home is appreciating, you're not merely buying shelter, you are acquiring an asset. You're building wealth passively. You are on the right side of a compounding advantage. And once housing became an asset class in practice, every major actor in the system developed aligned incentives to keep it that way. Banks. Higher property values mean more valuable collateral. More lending means more revenue. They benefit from rising prices. Governments. Higher property values generate higher property tax revenues. They create wealthier voters. And in every developed democracy, homeowners vote at higher rates than renters. They donate more. They organize more. They show up at planning meetings. They write letters. They are the core electoral constituency. Existing homeowners, their net worth, retirement security, and children's inheritance are all denominated in property values. Any policy that lowers prices is a direct threat to their financial position. Developers, higher prices mean higher margins. They have no incentive to flood the market with supply. Scarcity is profitable. And then a new class of buyer emerged. Pension funds, private equity, hedge funds, institutional capital. Discovering that residential property is a stable, appreciating, non-correlated asset class, housing is no longer just for people who need somewhere to live. When all these actors align, the system becomes self-reinforcing. Rising prices attract capital. Capital drives prices higher. Higher prices justify looser lending. Looser lending drives prices higher still. This is not a market-seeking equilibrium. It is a ratchet. It moves in one direction. Every asset bubble in history follows the same mechanical sequence. Credit expansion, rising prices, a collective belief that this time is structurally different, and the gradual exclusion of everyone who didn't get in early enough. The Dutch tulip mania, the South Sea bubble, the Florida land boom, the Japanese asset price bubble, the American housing collapse of 2008. But housing is categorically different from every other bubble asset. You cannot live in a tulip. You cannot sleep in a NASDAQ position. You cannot raise children in a speculative commodity. Housing is not optional. It is the base requirement for everything else: employment, health, family formation, civic participation. When the price of a non-optional necessity rises beyond the reach of working incomes, the consequences are not abstract. Japan's bubble peaked in 1989. At its height, the land beneath the Imperial Palace in Tokyo was valued at more than all the real estate in California combined. Residential prices in major cities reached 30 times annual income. The collapse that followed was not a correction. It was a lost generation. 2 decades of deflation, demographic decline, millions of households trapped underwater on mortgages they couldn't escape. A permanent scar across the economy's productive capacity. China is in the early stages of a comparable reckoning. Evergrande, country garden, tens of millions of unfinished apartments, 60% of household wealth tied to property, a residential market valued at more than $60 trillion, larger than the United States, European Union, and Japanese property markets combined. Prices are now falling. History has already answered whether housing asset bubbles are dangerous. What history has not yet answered is what happens when government decides the bubble cannot be allowed to deflate. That is the trap. In most developed democracies, between 60 and 70% of households own their home. These households vote. They vote at higher rates than renters. They donate to political parties. They organize. They show up. Their primary financial asset is their home. For older homeowners, it is often their entire retirement plan, their children's inheritance, their financial identity. A 20% decline in housing prices is not an abstract market correction for these people. It is a 20% reduction in their net worth, wealth they have planned their retirement around, wealth they expected to transfer to their children. Now ask the question plainly: what politician in any democracy will campaign on a platform of reducing home values? This is not rhetorical. It is a structural impossibility within the current political incentive system. Any policy that would genuinely improve affordability, mass public housing construction, land value taxation, restrictions on investor purchases, aggressive rezoning, would, by definition, reduce the price of existing homes. The people who own existing homes will not vote for that. They will mobilize against it. They will fund opposition campaigns. They will appear at council meetings. They will vote out anyone who threatens their position. This is not corruption in the traditional sense. This is democratic representation functioning exactly as designed. The majority is protecting its economic interests. The problem is that the majority got into the castle decades ago, and the drawbridge is up. This is why housing policy in every developed country follows the same theater. Governments announce concern about affordability. They commission reports. They hold summits. They promise decisive action. Then they implement policies that do nothing to lower prices. First homebuyer grants, deposit schemes, shared equity programs, subsidized loans. None of these reduce prices. All of them increase demand. Some transfer taxpayer money directly to existing homeowners by inflating purchase prices at the margin. This is not policy failure. This is policy success. The goal was never to make housing affordable. The goal was to appear to care about affordability while protecting asset values. The demographics of this shift are measurable and unambiguous. In 1980, the median age of a first home buyer in Australia was 25. Today, it is 36. In the United Kingdom, it was 27. Today, it is 34. In Canada, 25. Today, 35. The delay is not a function of changing preferences or diminished ambition. It is a function of arithmetic. A 2021 Reserve Bank of Australia study found that over 60% of first home buyers under 30 receive financial assistance from their parents. This is not a housing market anymore. It is a wealth inheritance system. The variable determining whether you can buy a home is no longer your income. It is your parents' balance sheet. Home ownership rates among adults under 35 have collapsed across the developed world. In the United States, from 43% in 2004 to 37% by 2016. In the United Kingdom, from 59% to 34% in a single generation. These are not minor statistical fluctuations. These are structural changes to a social contract that held for 70 years. The promise was explicit: work, save, buy, build equity, retire with security. That promise has been broken, not because the people who were promised it failed to deliver their end, but because the system that issued the promise was quietly redesigned. The economic distortions extend far beyond individual hardship. When housing is expensive, workers cannot afford to live near concentrations of employment. Commutes lengthen, productivity falls, family time contracts, stress accumulates, birth rates decline. Entire cities become inaccessible to the workers they depend on. When housing is an investment vehicle, capital flows into property rather than productive enterprise. Entrepreneurs cannot compete with rental yields for capital allocation. Startups cannot outbid institutional buy-to-let investors for financing attention. A 2019 study by economists Changtai Xie and Enrico Moretti estimated that restrictive housing policies in America's most productive cities had reduced national GDP by over 36%. Not a rounding error. More than a third of the country's potential economic output lost to the dysfunction of its housing markets. The geography of economic activity itself has been distorted. High productivity cities become progressively more expensive. Workers are priced out. They move to lower productivity regions. The output gap between cities widens. The workers who could generate the most economic value are systematically displaced from where they could generate it. This is not a free market. This is a market captured by those who entered it earliest. There are three logical endpoints to this system. None of them are comfortable. The first, prices continue rising indefinitely. Home ownership becomes a hereditary privilege. Society permanently divides into those who own and those who rent. A new feudalism with titles written in property deeds. Some countries are already on this trajectory. In the United Kingdom, over a quarter of housing is landlord-owned. In some American cities, institutional investors own more than 30% of single-family rental stock. The second, controlled deflation. Prices fall slowly over decades through deliberate policy. Existing owners lose wealth gradually. Young buyers gain access gradually. Pain is distributed across time rather than concentrated in a crash. This requires a level of political courage that no major developed democracy is currently demonstrating. The third, disorderly collapse. Credit tightens sharply, prices fall rapidly, banks fail, negative equity traps millions, foreclosures cascade, recession follows. This is the United States in 2008, Japan in 1990, Ireland in 2010, Spain, Greece. The aftermath in each case was not a reset to a healthier baseline. It was devastation, followed by years of reconstruction, followed in most cases by a gradual reinflation of the same asset values. None of these outcomes are painless. The only variable is who absorbs the cost and when. There's a final piece of the mechanism. Wealth that cannot be earned by the young will be inherited from the old. In the United Kingdom, intergenerational wealth transfers are projected to exceed $100 billion annually by 2035. In Australia, the transfer is expected to exceed $3 trillion over the next 2 decades. This is not wealth that was created. It is wealth that was allocated by policy and is now being redistributed by bloodline. If your parents own property, you receive a transfer. If they don't, you receive nothing. Your children receive nothing. The gap compounds. This is the logical endpoint of converting a necessity into an asset class. Not a market, not a meritocracy. A hereditary system. Birth determines access to wealth. Wealth determines access to housing. Housing determines access to security. Participation is determined by parentage. Historians have a word for social systems organized along these lines. It is not democracy. The question that underlies all of this is one that no politician, no central banker, and no treasury official will answer directly. What is a house for? Is it a place to live, or is it a financial asset? Because it cannot function as both simultaneously. If housing is a place to live, prices must remain proportional to incomes. They must not appreciate faster than wages. Housing must not serve as a retirement vehicle or an inheritance mechanism. The expectation of price appreciation must be abandoned. If housing is a financial asset, prices will continue rising. Young workers will be progressively excluded. Wealth will concentrate among those who already own. The window for entry will narrow with each passing year. These two objectives are mathematically incompatible. Every politician who claims to support both is either lying or hasn't worked through the arithmetic. As societies, through tax codes, credit policy, zoning law, pension architecture, and electoral incentive, we have made a choice. We have chosen the asset. We did not choose it explicitly or consciously. No one held a referendum on converting residential property from a consumption good to a speculative instrument. But the policies accumulated, each one individually defensible, collectively decisive, and the outcome is the system we now inhabit. History has a consistent pattern when assets become detached from their productive value, when prices are sustained not by utility, but by the collective belief that someone else will pay more tomorrow, when the primary beneficiaries are those who entered earliest, when the young are told their only options are to wait for inheritance or accept permanent tenancy. That system does not reform itself. It does not correct gently. It does not choose fairness. It continues until it cannot. And when it stops, the cost is not distributed proportionally. It is not absorbed by those who profited most. It falls on those with the least capacity to absorb it. This has happened before, in Japan, in Ireland, in Spain, in the United States. The question is not whether, the question is when, and what remains after.